Today we're going to talk about what it costs to build a home here in the United States. Spoiler alert, costs are going up. We all know that. Bless you, inflation. We're going to talk about the most important housing metric in the United States, and that one is inventory. We're going to talk about the top 10 markets according to Zillow. Like, where is it the hottest in the nation? What are the best housing markets? And last, we're going to look at a couple tweets on X about what it's like to be in real estate, and then owning stocks versus real estate. Those are our topics today.
All right, Anton. I've been wondering too, because I want to build a house here. How much is it going to cost me?
A boatload of money.
Okay. I was thinking today when I was running.
Yeah.
Didn't lumber costs come down?
Well, lumber costs, and they talk about this in this report. So this is from the National Association of Home Builders. Lumber costs have come down since their pandemic peaks, but they're still elevated. And then what is Trump's favorite word?
Tariff?
Tariff.
Oh, no.
No. So that could mean OSB gets more expensive. It could mean lumber gets more expensive. Now, I realize that both with Canada and Mexico, we said we were tariffing them, and then we've come to some type of an agreement. Agreement is a pause. So the tariff is still coming. So we have to assume lumber costs are going to go up. And especially OSB, most of that's only made in Canada. You and I, we've talked about stuff like zip sheeting before. Zip is made in the US. So if it gets really expensive, you might want to just use zip on your project versus OSB, because all of a sudden OSB could cost 25% more. So why not pay for the more superior product? In 2024, what do you think the average sales price, don't look at the notes, was for a single family home in 2024 across the United States, new construction?
Oh, new construction?
Yeah.
600,000?
665.
I looked at the notes.
Yeah, you looked at the notes.
Sorry.
And though, when we compare and contrast that to the average price of a resale is 420, realize that new construction home is 240 grand more, because like we've talked about before, builders are not building smaller product here in the Seattle metro, but they're also not building it across the US because they're not making as much money.
Is that because the cost of building is so high, so they have to build bigger to create a better margin?
You're nailing it. With the smaller property, they don't have as big of a margin, so they can't make as much profit. As the property gets larger, aka 1,800 square feet and above, the builder has a larger margin because it's a more expensive product, which actually is removing risk from them. So out of that, the National Association of Home Builders believes that $428,215 was the actual construction cost of that, which is 3.2% higher in sales price and 9.2% higher in construction costs, almost 10% higher than 2022. What's been happening is demand has started to cool a little bit, but labor is more. Inflation has made everything cost more. So these builders are also having to offer incentives in order to move inventory. What's interesting is they talk about this idea of that framing costs are slightly lower than they were in 2022. So framing costs are the only ones that are down. In 2022, it was costing about $60,831. In 2024, it was costing $49,763. So that's around $11,000 less. I can tell you here in the Seattle metro, we have not experienced what you're seeing nationally on that framing cost. It did come down, but it's not near that number.
And that's a result of lumber coming down, because that's a majority of the product you're using.
Yes, exactly. Result of the cost of lumber coming down while labor went up. But the problem is here in the Seattle metro, labor has gone up disproportionately. We don't have as many construction workers here in the Seattle metro as they do in Texas or Florida, for example. I'm just going to go through some of these other numbers just so people can take a look at this. Excavating, foundation, concrete, retaining walls, backfill, $43,000. And once again, I'm just going to round off some of these numbers. Electrical, $27,000. Plumbing, $27,000. HVAC, right at $27,000. Exterior wall finishes, $24,000. Cabinets and countertops, $19,000. Roofing, $16,000. Windows and doors, $16,000. Drywall, basically $14,000. Interior trim, $13,000. Trusses, sitting at $13,000. The driveway, I thought that was kind of interesting. Driveway, almost $10,000 for the driveway. Other, if you've ever built a home, your other list becomes so big. The additional punch list becomes so big. The custom items you're going to add in. So I love it. Other, $9,000. Permit fees, $7,600. Well, not here. In the Seattle Metro, those permit fees were, depending on where you're at, are anywhere between $20,000 to $30,000.
Jeez Louise.
So we're 4 times the national average.
Why is that?
Come on.
Just give me the short answer of it.
Because we're a tree-hugging blue state that has a lot of regulation, so our fees are extremely high. And a lot of the new construction that's been happening, the big chunks of new construction have been happening in the South and in the West. So Utah, Texas, Florida, red states, a little bit less regulation, cheaper to do it.
Wow.
Plain and simple. Okay, getting back into this. Plumbing, $8,000. Oh, we talked about that. Insulation, $6,000. Sheeting, $6,500. Architect and engineer, $6,500. That's going to cost you $15,000, $20,000 here. It's just interesting when you kind of compare and contrast some of these. Your impact fees, about $6,300. Water sewer inspections, another $6,300. On-site work, $6,000. Lighting, $5,400. Outdoor structures, aka decks, patios, things of that nature, $4,700. Cleanup, $3,200. Fireplace, $1,747. You know, Washington State, we tried to outlaw gas fireplaces and fireplaces here. General metal, steel, $1,700. Other final steps, $900. Rough-in, $800. Interior finishes, $8. Exterior finishes, $4. Other framing, $90. When I look at these numbers from a percentage basis, this is right in line with us, except for I will say our fees are higher, our engineering's higher, our surveying's higher, our impact fees are higher, things of that nature. But on a percentage basis, this feels like what you see here in the Seattle Metro.
So what should builders be thinking about if they're going to build this year? And is it smart to wait for prices to get better, or are prices not going to get better? And if that's the case, what are things they can do to save money?
Yeah.
Or where do you, not necessarily cut corners, but where do you try to create savings if you need to be able to build?
Great question, man. So whether you're a small home builder or you're an investor or you're looking to build your first home, the biggest way that you can save is on the land. I know this sounds crazy, but the final price is most determined by the price you pay for the land. So if you can purchase the land right, you can know that you will have a profit at the end, or if you're building it for yourself and your family, that you will create equity. That's number one. Number two, actually sticking to the budget. With all the customs I've ever been involved with, I have never, ever, ever, ever seen someone not blow the budget. In one that we did, this is no joke. So we're looking at the budget, and I go to one of the guys. I said, why are the doors and everything associated with them so freaking expensive? He goes, well, we're blowing the budget. I said, what are we blowing the budget on? He goes, custom door hinges. I go, what's a custom door hinge? A door hinge itself, the little thing that goes in the door jamb, a couple bucks. $250 each, and there's 3 per door jamb. So all of a sudden that becomes thousands of dollars multiplied over every door. So he said to the client, are you sure you got to have the custom door? You know, you're never going to see it. And the wife says, no, I'm in love with him. All right, you're the boss. Make it happen. It's little things like that. I was chatting with my brother-in-law as he was working through property that he was building in Kenmore. And I look at the hard surfaces. and the hard surfaces are 3x what they should be. I was like, what are you putting in here, brother? What are you doing? And he goes, oh, well, I found this special Venetian marble. I said, do you have to have it? I was like, this number is 80 grand and it could be 20. So what happens is, and I think supply businesses almost do this on purpose. They know customer behavior. And so you walk in and you've got granite, for conversation's sake, whatever it is, granite tile, and you've got the rows, and you're walking through the rows, and at the end of the row, with a special spotlight, everything else in front of you is $4 a square foot. And at the end of the row, there's one that's $12 a square foot. And for some reason, that it naturally guides people right to the expensive one right there at the end, when it may not be an actual better quality, or it may just be the trendy item of the moment. So I think that's one thing to be aware of is, one, people blow the budget. Two, they overdo things. Three, they don't work on value engineering the product. After you put your I'm in love with this, and the designer did everything with it, and the architect did everything with it, you should go back to the builder and say, if this was you, how would you value engineer this? And then you take it to someone else who's not associated with the project, who knows construction really well, and say, hey, how would you value engineer this? For example, beautiful roof, but this roof had all these valleys, and every valley cost money. Every intersection, every additional truss. So when you see a beautiful facade on the exterior of a home and it's got multiple layers to it, realize that the layers on the facade, that's more money. The intricate roof. So we simplified the roof and we saved $39,000 because it was a beautiful roof, but it didn't need to be that crazy. So we went to them because they said, hey, would you value engineer this? And we said, is all of these turns and valleys and different elevations important to you in the roof? And they're like, absolutely not. Okay. So we dropped it from like 12 to 6, just cut it in half. So still very visually appealing. You know, that's the problem. So sometimes when you value engineer, you end up with this vanilla box, and it depends on the customer's goals, but you want to make sure that they're going to get something they still are in love with. Also, people change their minds too late. Pick it out up front, and then when the process is moving, don't change your mind again, because then what it does is it slows down all the trades behind it. It delays the carry cost. Make sure it's still in stock. And if it's an item that moves out of stock quickly, buy it and throw it in a shop, because the worst thing that happens, and we saw this a lot during COVID, is you're working through a project and there's the I must have item, and all of a sudden it's out of stock, or it's going to be delayed 3 weeks. But then every other trade behind them is delayed. Those are the most common mistakes we see in this stuff.
And my last quick question is, should people wait for prices to go down? Do you think it will go down eventually, like next year or later?
I don't think prices are ever going down. Here's why. There's some logic behind it. During the great financial crisis, we printed $5 trillion. During COVID and the two administrations during that, yes, the Trump administration, and yes, the Biden administration, Republicans and Democrats are both to blame here. We printed 13. And 13 trillion in money floating around in a circle. That's why we're still running a $2 trillion deficit. It's too much money. There's too much inflation inside of the system. And you're seeing that inside of the bond market. The bond market, as the Fed cut, said, U.S. has got too much debt. We're not ready to lower rates yet, even though the Fed was lowering rates. That's what kept it artificially propped up. So when someone says, I want to wait, I'm telling you, unfortunately, based on what I'm seeing from my perspective, in my humble opinion in economics, is that prices are only going to be more expensive because inflation has not cooled all the way off. It's just going to be more. It's going to be more expensive to build in 26 than it will be in 25. However, your debt may get cheaper. So the thing to be thinking about, and kind of a fun way to hack this, is I can pay a higher price today because 7% interest rates, and there may not be as much competition for that custom home. There may not be as much competition for the subs right now. knowing that I've got lower debt coming because we've most likely seen interest rates peak. So low debt's coming. So our thought is, oh man, it's go time. It's on like Donkey Kong. We're building our investments. My goal is to start building our house this year. We're building stuff for other clients. We're building stuff to sell. It's go time.
It's go time. Second topic today, what's the most important and key housing metric that people should be thinking about, and what is it?
Inventory. So what's been forcing up price throughout the US, and especially here in the Seattle metro, is inventory. It is simply the lack of supply. Everyone wants to blame the boogeyman and say, no, it's this hedge fund. No, it's this. It's the lack of supply due to not building enough homes, from overregulation and lack of funding. In the Seattle metro, we're almost the absolute worst in the nation. Just the whole West Coast, horrible at this. I was looking at Resi Club. They do a phenomenal job of displaying this data. And they went through and cracked out, because the news media right now is saying inventory's rising. It's up 25%. Prices are going to crash. So let's look at the real data. We've talked about this before. When you see something, go dig into it. Ask, what is this telling me? What does it mean? And why is this person saying this? In January 2025, there were approximately 829,000 active listings in the United States. So when they say inventory is up, in 2024, we had approximately 666,000 listings. So it is up. But what is it up relative to? If we go back to 23, it was 617,000. If we look at 2022, it was 376,000. That was the market overheating from the pandemic boom. In 2021, because of cheap debt, same thing, market overheating, we had 532,000. In January of 2020, 951,000. But before the pandemic, so let's call that the normal market. In 2019, 1.1 million. In 2018, 1.04 million. In 2017, 1.15 million. So when we say we're at 829,000 and inventory is up 25%, the sky is falling, so prices have to drop. We have not returned to pre-pandemic levels.
I wonder if you put the population growth next to all these years, if it's gone up.
No.
And if,
Our population?
Yeah.
Yes, the population in the U.S. went up that whole time.
Yeah, so that means that there is more people that would like to be in a house.
Yes.
And with low inventory, but not just high demand. There's probably a lot of people that just don't think it's even possible because prices are too high and there's not a lot of options.
They don't think it's possible, and then 7% debt makes it very expensive for them. And what I would tell any first-time home buyer, go talk to a lender today. Figure out where I'm at from a credit perspective, figure out where I'm at from the lender's perspective and what I need to save. And have the lender create the plan and the process for you to get your credit ready, save for the down payment so you can buy a home. It's one of the easiest wealth creators in the whole wide world, but it's also, there's an important factor that Gen Z, I think, is starting to miss. Yes, housing is stupid expensive. Yes, renting is cheaper. And yes, it does tie you down. But what it also does is it creates a pride of accomplishment. It shows you that you can accomplish big things, that you now own a $700,000 asset, a $500,000 asset, a $1 million asset. It becomes this beautiful forced savings account that for the majority of Americans is one of their largest pieces of net worth. So if you look at, and I don't have the data because I didn't realize we were going to talk about this, but if you look at the level of wealth that the average renter has versus the average homeowner, there is a 10x or more difference in that. Why? Because when you're renting, you generally have a renter's mentality. Now, some crypto bro or some stock trading bro in the comments is literally going to say this is what they always say, but I could make more money in the stock market. Yeah, but can you live with your Nvidia stock? But I could make more money in crypto. Cool. Can you live with Bitcoin? you can't, and you have to live somewhere. So my opinion is buy a home. Now, if you want to house hack that, okay, move in, buy the place, rent out all the rooms. There's ways that you can make money if that is our only goal, and you'll make money quick.
Is that a good segue to talking about investing in stocks versus real estate?
Oh yeah, well, we could totally do that one right now.
Because I think that's a great thing to consider. It's like, what are the things you want to know or think about when deciding where to park your money?
Yes.
And by the way, Neutrally, you hear that? If you want to be 10x your wealth of your friends, gotta own a house. So get on it. I know an agent that can help you.
I want you to actually read number 5 there.
Okay. All right. The rich own stocks, low middle class own real estate.
So this was shots fired. And then read Exhibit 10 and Exhibit 13.
Exhibit 10 is the top 1% of households by wealth allocate 61% of their assets to equities. Equities being like stocks and commodities and
Stocks,
other
bonds,
investments,
business
like that.
ownership. Yes.
Exhibit 13, the bottom 50% of households allocate 4% of their assets to equities.
So this is always the way it is. Where's the individual's level of motivation who's saying this? So this was being said by a stock trader. So what they're saying is buy stocks versus real estate. They're saying rich people own stocks, poor people own real estate. I will tell you, this is absolutely untrue. However, you can frame it in a certain way. What do rich people have that is considered equities? What they have that other people don't have is they have ownership in their business, which is also a form of equity. So a lot of rich people are business owners and entrepreneurs. So this 61% in equities that they're referencing is outweighed by the people because they own their own businesses. And then they say only 11% is real estate. And that number is actually true. When you go and look at ultra high net worth individuals, the number is between 11 to 13% of their total net worth is in real estate. The problem is the story we just actually told. There are people who are low middle class who just bought their first home, who don't have an asset base saved up, and that becomes their only nest egg. So he's cutting the data in a certain way so it makes it seem like only rich people own stocks and only poor people own real estate, it's just untrue. Last week, I may or may not have had an individual show up in a Lamborghini Urus, and they may or may not own 1,500 units in this county. And we had a negotiation in regards to a specific property. And I actually said, hey, do you invest in stocks? He goes, we're real estate people. It's like, we're a family of real estate people. Why would we do anything else? So there's also that extreme too, where they're just all in on real estate. I think if you want to be richer or the richest, you want to start a business, own a business. You want to buy real estate, and you want to build a stock portfolio because you can leverage your stock portfolio just like we do. You get a line of credit against it, and you can go use it to go buy more real estate. Where do I get the best returns? Real estate. What do people believe? Because we have this recency bias. The stock market over the last few years, due to money printing, has outperformed most asset classes. You know, what did the S&P do last year? Like 20%?
Yeah, a lot.
Yeah. Is that normal, or is that double, triple the average?
Not normal, for sure.
Bingo. Because we printed so much money, and this is the great asset melt up. We've been talking about this a long time. The stock market ripped. So people say, oh man, I should only invest in stocks. Go back and look over it over 100 years. Over 100 years, you're basically getting 8 to 12%. Cool. We do better than that in real estate. And what people would argue is they'd say, oh, real estate's, if I buy it based on a cap rate that can be thought of as a yield, I'm only getting 5 to 6. Well, what did we just say about building a home? Buy it right, add some value, and make double that return, or don't do the deal, or do a land development deal, but do something else that's going to give you an above average return. Now, if you just want to park money and don't want to think about it, absolutely, you'll get single digit returns in real estate.
In real estate?
Yeah.
Yeah. Well, other thing too, I know that we probably speaking to more investors, but say you're on the fence of should I rent or should I own? It's almost necessary now to have at least ownership in your house because of inflation. Because it just protects you from inflation. Because when you're renting, guess what? Else inflates, your rent inflates over time and everything gets more expensive. I mean, you just need to own one house that you pay whatever the price is now, because 10 years from now, you're going to be thankful you did. You might not become super rich off of it, but at least you won't be sitting here 10 years later looking to pay for a house that is going to be potentially double. I mean, it's just crazy to think about that. And then on top of it, it's just everybody else that does own a house, or especially owns multiple or a whole portfolio of it, are just going to be light years ahead of you in terms of wealth. And the people that have nots, right? Because they made the choice to have rent because maybe it was less, you're going to get even more poor. And it's harsh to say that, but it's true more so now than ever because of inflation.
So true. Benji, you're nailing it on the head. As inflation continues, that's going to push it up. And to give a real life example of this, we went out to dinner last week, and one of the couples with us had purchased their home in a local neighborhood that's affluent. The home would be worth $1.1 million today. They purchased it for less than $500,000. Their mortgage is $2,700 a month. To rent their home today would be like $5,500 a month. And we were talking about this idea of moving up and moving closer to another family member. They can't afford to move up the property ladder and closer to this other family member because their mortgage would more than double. So they'd be paying $7,000 a month just to simply move to this other neighborhood because rates are so high right now. And one thing for the renter, I want you to be thinking about this, or even for our real estate investors, is that when COVID happened, interest rates came to an artificial low, and that artificial low caused a boom in multifamily development. That multifamily development happened in 2020, 2021, and 2022. And to develop a larger multifamily is, generally speaking, a 3-year cycle. The Fed raised in 2022. So the last of all of that across the U.S. is coming through right now. The last of the huge multifamily development glut that's coming through, because the number significantly dropped in 24, and of course it's going to be low in 25. What that means is sometime in 2026, rents should jump just due to the lack of multifamily land development that started back in 2022. It's coming. Mark my words. I would expect, so prediction, 5% rent growth, 6%. Okay, that's really high for people who don't follow this type of stuff. 2% rent growth would be normal. 3% rent growth. If I say 5 or 6, that's double the normal.
All right, let's get into the next topic. I'm not exactly sure what this means by top, but Zillow's top 10 housing markets for 2025. Can you explain what's the context of this list?
Yeah, what Zillow said was they picked this based on a mix of affordability, job growth, and community. So they created their own list of metrics. What's interesting is Buffalo, New York hit the number one on this list for the second year in a row. It's actually been named that by multiple areas. And it's because values jumped and they're expected to see another 3% growth. It's still semi-affordable relative to New York. Number 2 on the list, Indianapolis, where they expect prices to rise around 3.4%, $285,000. Providence, Rhode Island was number 3. Hartford, Connecticut, Philadelphia, St. Louis. You know what's interesting about St. Louis? $254,000 in St. Louis. That's really affordable relative to the national price at $420,000. Charlotte, North Carolina, because so many people moved, that became one of those boom areas. They're hitting almost $400,000, and they expect it to appreciate about 3.2%. Kansas City, Missouri, you're looking at about 308, expected to appreciate 2.7. Richmond, Virginia. Salt Lake City, Utah. Ooh, expensive. So Salt Lake was one of the most expensive ones on this list, expecting to reach about 556,000 and grow by 2.3%, where homes are selling in less than 20 days. What I always find funny about these, you never see anything on the coasts. Why? Both of the coasts are just so stupid expensive, and
There's nowhere to build.
And there's nowhere to build. So I wanted to kind of bring up some of the Seattle metro metrics in regards to this too. So I pulled up the King County numbers, and King County is where Seattle is. So that's our most populous county in the state of Washington, and that's where Seattle's specifically located. New listings versus last year up 33%. Okay. Pending sales up 16%. So once again, if you look at this and you go, man, listings are up 33%, prices have to crash. The bidding wars are back in Seattle. The bidding wars are back right now. Our spring market has started early, and we've been seeing bidding wars at the bottom end and at the upper end, and it's busy in the middle, but not like bidding war insane. So it's kind of this idea of a bifurcated market. It's not enough inventory in the affordable price ranges, which is creating bidding wars and massive demand. And then another example of the rich getting richer and their asset columns growing because just massive bidding wars. And I'm talking like double the median price and above. Closed sales already up 6%. So in part of our predictions, where we were talking about what we believed was going to happen in 2025, we had said the Seattle Metro was probably going to sell anywhere between 6 to 15% more homes. We kind of settled on like 10. I feel very comfortable saying we might sell 10% more homes this year. Days on market was slightly up, but we had some bad weather during that, so I'd almost ignore that one.
What was it? What's days on market?
45.
Versus
42. I mean, it's such a minuscule difference. What's very interesting is the King County median sales price, $855,000. The average sales price, $1.176. Almost $1.2 million is the average sales price in King County. That blows my mind. People look at the new listings one and they go, the market could crash. But if you look at supply in January of 2025 was at 1.2 months, AKA stupid low. So last year, when we told everyone the bidding wars were coming back in the spring, I'll be blunt, I didn't expect it to start so early this year. And it's already started and inventory's already low and everyone wants to buy. Part of this, I will say, even though we're a blue state, is the Trump effect. It's kind of this positive outlook on the economy and that things are going to get better. It kind of doesn't matter right now if you're Republican or Democrat. There's this belief in our area that the economy is going to get better. And, I believe it too, because it feels like we're winning the inflation battle and that, you know what, we might beat some of this regulation and we're going to get this 10-year treasury under control. Before we started recording, you had asked something about the 10-year treasury. What?
Oh, yeah. Well, so the 10-year treasury is basically the interest rate that the government pays for debt, or it's like representative of it. And it's been going up to record highs, making interest rates for your mortgages record high. But in the last, I want to say 2 months, at least 45 days, that interest rate has gone down. The 10-year rate has gone down, meaning mortgage rates should be going down.
It did, just a little bit.
But they're not going down as much as the 10-year. Anyways, I was just curious why that is and if it's going to continue to go down. Because if it does go down, that means mortgage rates would go down later this year potentially.
So you can think of the 10-year as actually the barometer for all consumer debt, for credit cards, for auto loans, for student debt, everything, home equity lines of credit, purchasing real estate. Now, of course, they're all different rates than that, but generally whatever direction that's going, most of those are going to follow. So as the 10-year gets cheaper, realize debt for consumers is essentially just getting cheaper, number one. Number two, as debt gets cheaper, demand increases and spending goes up. So if you're thinking about, oh, maybe I should buy a home or buy an investment property in 2025, if we know that debt is going to continue down, then more competition, more demand, and rising prices is coming. Real estate specifically, there's a margin between the 10-year treasury and our 30-year debt. Generally, it's 1.8%. Right now, it's about 2.6. So what you saw was the Fed cut rates, and the bond market essentially get pissed off about it, and rates go in the opposite direction. Why? They're saying the U.S. is spending too much, we don't have inflation under control, and the economy is not slowing down. So the bond market was saying, we don't want the economy to overheat. President Trump gets in, everyone's worried about tariffs. He says tariffs. Bond market actually moved slightly down when he launched his tariffs. Part of what we're seeing is what I believe is the bond market starting to believe, one, we're beating inflation. Two, through Doge, through the government, through this changing of government spending, because that's part of what this is. The reason our debt is so expensive for the U.S. treasuries is because the rest of the world says, United States, you are on the Titanic, you are headed for the iceberg, you can see it coming, you're going to sink the whole ship because you cannot run negative $2 trillion a year. Minimum, that's what we're running right now. So as Doge cuts, and this is a whole different argument, so I don't want to get into it, but as Doge cuts $10 billion in spending here, realize it's a double whammy. That's $10 billion in debt that the U.S. didn't have to originate. So it's less debt we have to take on. It's less debt we have to pay back. Plus, we're doing what the globe wants us to do and get our house in line and stop spending like a drunken sailor. That is why the 10 years treasury down or trending down. That's why the 30-year debt was like 7.125 and we're at 6.9 today. So it's moved quite significantly. It's not going to massively drop. This is what everyone thinks. They think once it starts moving, it's just going to fall off a cliff. This is going to be a slow road to 6. If we're lucky, we'll get to like 6.25 or 6 by the end of the year. But we have to keep showing the rest of the world we're fiscally responsible. We're cleaning up our house. We're stopping our spending. I believe we've started that, and I believe that's why the bond market is starting to move that way. If that continues and we lower the government deficit, not the amount we owe, but just the actual deficit spending, rates should come down quite significantly. That could push us over the next 2 years into the low 5s, which in that case, real estate lights on fire. It's on like Donkey Kong. Lastly, this is not financial advice. A lot of what you're seeing there too is as the bond market was trending up, the short, it's sexy. And everyone starts shorting the treasury. They start piling in. So the treasury probably, the 10-year specifically, probably swung higher to the high side than it needed to because the stock market piles on and everyone's shorting it. Would you bet against the United States, Trump, Elon, Vivek, RFK, Tulsi Gabbard, and the whole giant list of them that they're not going to fix that problem? Well, the United States in the popular vote says that's a bad short right now. And so as those shorts clip out of the market, that could pull probably not quite a quarter, but maybe 0.125. That a lot of this is just the pile-on effect. And then once it starts moving down, the pile-on effect will happen and force it lower too, assuming inflation is under control, and the last inflation read looked really good from PCE. And the last jobs report was throwing another Mayday warning sign. And if we're cutting government jobs, and we've talked about this on previous episodes, our subscribers know this, is that a majority of the jobs that were reported was government and healthcare. If we're cutting government jobs, that means the job data could turn very quickly. What we don't want to do is we don't want to back ourselves into a corner where the U.S. economy slows down and our debt is really expensive and we're losing a bunch of jobs. That's stagflation. That's a recipe for disaster. I'm excited with the direction we're currently moving right now.
Awesome. I guess the last topic we're going to talk about is what it's like to be in real estate right now. And can you tell us, is that as an agent, as an investor, buyer or seller, or just in general?
Read John's tweet there.
John Goetz tweeted this on, it says today.
Yeah.
So what it's like being in real estate. Hello, is 157 Grady Drive still available?
And
Hi there. Yes, it is. I'm not surprised. It looks like shit.
Okay, so this is like quintessential real estate. Everyone thinks real estate number one is like HGTV and we're all selling $1 million homes and not being shit on by another agent or by a consumer. I'll be honest, it's a tough business. I absolutely love it. I think it's the best game ever invented. But this point proves something. I'm not surprised it looks like garbage. Inventory is still low throughout the United States and especially here in the Seattle metro. So if a listing is still on the market, the consumer and the agent goes, there's something wrong with it, or it's broken, or it's a piece of garbage. This was more just for fun. It's this idea of, if it's on the market for too long, it turns into a brown banana. Is real estate hard, and do people talk to you like this? They 1000% do. But you also have to kind of back away from it. Buying or selling real estate is the third largest cause of stress, right behind death of a loved one and divorce. Your buyers, your sellers, your investors, they go through this emotional cycle. They go from freaking euphoric to, oh my goodness, I'm depressed, it's never going to work. Because real estate, even though they're buying it, it's not a commodity. It's where we have dinner with friends and family, and it's a basic human need that everyone needs. So this just made me giggle. This is quintessential real estate, brother.
So how do people find you?
You can reach us at resg.com and 425-249-0214. Always happy to answer your questions. Drop any questions that you guys have below, and we'll chat with you more.